All right, looks like we're live. Welcome everybody to live valuation. Uh, Sorry we're a little bit late today. Had to switch the schedule back 30 minutes from when it was originally scheduled, and then I'm also a couple minutes late even on top of that. But had a bunch of errands to run this morning. But anyway, we're going to be getting into uh, Interfor today, which I'm pretty interested to show you guys what I got with that one. It's a company we have covered on the channel before, a lumber producer. IFSPF being the ticker, an over-the-counter stock. Here's our watch list as we kind of typically start by looking at. I do actually have Interfor listed on here, and it's actually pretty high up on the list, which should be an indicator of where we're going with this one today. But there's definitely some caveats to be had with the valuation either way, but we'll get into that. But either way, actually forgot to announce it on the Discord, which I've kind of normally been doing, announcing my buying. So, I mean, this week I bought a bit more with Smith & Wesson. Like I said, I started a position in that most recently. Also been a little bit more of the Buckle. That's another one I've been buying pretty regularly and building up the two positions in. And shifting around some other positions. If you check out the video that I put on the channel last week covering the Q2 market update, which includes information about my own portfolio performance. In that video, I talked about some of my top 5 holdings that I'm kind of been shifting around some of my views on. Just recognition that some of them weren't quite as great values as they otherwise could have been when I purchased them, that being Corsair and Biogen and also Alibaba. I haven't been trimming Corsair. I am just on holding for that one. Look at you looking like a real human being. Hey, thanks, bro. Glad to see you're watching live. And I saw that you messaged me. I was just kind of running around a little bit before I wanted to go live, so I'll definitely be getting back to you after the stream on that. Perhaps we can chat later on that subject. But anyway, with that, I have been kind of readjusting my valuations for Alibaba and for Biogen. Definitely still holding on to both of them, but recognition that Biogen was based off of a thesis of future revenues having to do with future products that they have, and while anything to do with the future means that it's more earnings that's not more in the present, and that's the type of stocks that have been repriced in the last few months, is companies that have more future earnings relative to present earnings. Alibaba has pretty strong present earnings and also pretty strong future earnings, so it's a little bit of both in that regard. But then there's just also the adjustment for the risks that exist within the Chinese system and the ADR structure associated with it. So I kind of found a way to sort of adjust my stock expectations for that company based off of what I think of as the risks associated with that. And it's a great bargain if you basically ignore those risks, is basically how it comes down to. Either way, I was kind of repricing those in the portfolio a little bit. So with that, I was also talking last stream about what I might be doing after this one. I'm also considering taking a look at EAF, which is GraphTech, another company that we have looked at on the channel before, and perhaps Kroger after that. I was saying I wasn't sure whether or not I wanted to value them last time, but I'm kind of considering doing so again, because then I was kind of reminded that they're in some of the more qualitative, they rank pretty high on the qualitative list that I had put together for some of my stocks, which are the ones that are coded green in this column right here. So I was like, you know what, I might as well do the Kroger one again just to keep it fresh, since it's one of those higher quality companies in that sense. And then I am on the horizon for the new 10K for Alibaba and Microsoft and Sandfire Resources in the near future. So with that, we can start to get into Interfor. Before getting into the actual valuation, I'll take a quick look at their investor presentation, just a few details from it. I'm not going to go all the way through the entire thing. Just kind of talking about some of the things that they've done in the last year, especially in the last quarter. They most recently closed a new acquisition with Ecom in Q1, increasing their production by 25%. They've definitely been growing pretty significantly. They're definitely a really, really strong player in the North American lumber space, and they've been doing a significant amount of capital return. Pretty significant amounts of share buybacks for the last few years, but they've been consistently doing share buybacks, at least in small amounts, for several years. But they also did a really large special dividend in this last couple quarters. I actually have expectations that they might continue to do special dividends in the future, because they have cash on their balance sheet that's basically in line with the same amount of cash that they've had when they made that decision before, and they're likely to continue having those cash levels moving forward if they continue to earn what we expect them to earn in the next quarter or two at least. So with that in mind, I think there's a good chance that there can be special dividends, more share buybacks, and possibly more M&A as well if other players aren't doing it as well. But with that, we'll get into the actual valuation that exists just within their own stock, and that can show why the buybacks themselves are also a good opportunity. So they've been increasing their production pretty significantly, that partially on the backs of the M&A. We're going to skip a little bit further down to here where it shows them against their peers, positioning them North American lumber production by company as of 2021, showing that they're now the fourth largest player in North America. They used to be a little bit more focused on Canada as of where their actual production lines were, but these acquisitions they've done in recent years have given them a much larger footprint in the United States, and now that's actually the largest footprint of where their ownership was. It was the largest revenue share regardless, because obviously it's just North American lumber. Obviously United States is going to be a huge buyer, but you can kind of see that right here, the lumber sales by market. Yeah, 88% United States, a decent amount China and Taiwan and Hong Kong, and then Canada, and then Japan and other. So with that, we'll actually get into the valuation itself. As you can see, I do have a pretty strong value up here, and this is pretty much in line with what I think of the stock. We're not necessarily going to make too many adjustments per se, but there is a few things to bring up. Hold on, actually, just one second. I just realized I was going to try to bring up this one page. Oh, no, I didn't actually. Damn it. There was one little page that I found when I was doing research for this I was going to try to bring up, but I realized I never saved that link, so I might not be able to get that. Oh, well, whatever. So starting at the bottom, as we normally do with the segmentation, obviously they're just in the paper forest products market. The unlevered beta for their industry is 0.94, sales capital ratio 2.71, and adjusted net margin 16.56 in the most recent year. So really high margins in the most recent year. That is in the most recent year, and they're not necessarily going to always have margins like that. In fact, their margins are a little bit more chaotic, which is what the link that I had was a website that I had found that gave me pretty good information on that. I don't think I saved that. Oh, that's right. Never mind. I did put it over here. I don't know why I kind of forgot, but I went looking for a website that could give me information on this industry's financial ratios over the last few years, because I didn't want to just take 1 year in mind. Now, this data set that I get my margins from isn't necessarily the same data set where this is coming from. They might be doing it strictly off of the S&P. I'm not sure. Because the profit margin that they're getting is 7.9% in 2021, whereas the profit margin I got from the data set that comes from Aswath Motoron says 16.56%, and that would be, I believe, US either way. It's possible that this is, oh no, they said US listed right here. Average industry financial ratio for US listed companies, lumber and wood products except furniture. And I'm pretty sure that's basically the same industry, but he might be including more small caps, and is what that might be. But either way, I wanted to find another source for previous years, and they had 6 years listed right here, as well as they also provided median information as well. So I kind of took both of those things into account and was kind of basically comparing the profit margins of Interfor over those same years relative to the averages and the medians found on that website. And I basically found that over any consistent time frame, Interfor has generally had 2.21 times the average and the medians kind of mixed together. I was just trying to get as many data points as possible. They're relatively closer to each other, and the average actually was lower than the median in a handful of the years, so it didn't seem like outliers were necessarily pulling it too much. Either way, the point is 16.56 is a little bit of a high margin for a single year. Perhaps 8 to 9% is a little bit more reasonable of an assumption for the most recent year for the entire industry. But either way, we'll take a look at Interfor's margins when we get into the financial history. So taking the levered beta of 0.94 and adjusting it for the debt to equity ratio is 25 to 26%. I come up to a levered beta of 1.13, and that brings me to a cost of equity of 9.76 after adjusting for the different geographies that they operate in. That is the 25% debt to equity ratio comes on the back of $421 million in debt and lease liabilities that they have, which come at a weighted average maturity of 5 years and a weighted average interest rate of 3.95%. So a pretty good interest rate. Not as many years as we would like. 5 years is kind of at the end, obviously, of our projected time frame, so it means that there's a decent amount of it that might have to be rolled over during that time, but overall the interest rate's at least pretty good. they obviously might have to adjust for higher interest costs moving forward. So with that, we can kind of take a look at their financial history. They in 2012 had $849 million in revenues, and that has grown to 3.2 billion or so in 2021. So very, very strong growth. If you take a look at the 5-year COGR on a rolling basis across that time frame, it shifts from anywhere from 18% over a compounded basis to 5% in some of the lower points. So a little bit chaotic, but on average, those rolling periods average out to about 11.34%. So perhaps 11% per year over the entire consistent time frame. Very, very strong growth in revenues. The gross margins also shifted around pretty significantly. In the first 5 years, we had average gross margins of what was it, average of 12% or so, and then in the last 5 years, it's averaged 22.5%. That large average of 22.5% does come on the back of the 41% that we have in 2021 and 27% in 2020. So obviously it's definitely being pulled upward by that fact. But either way, very, very strong growth in the gross margins. If we take a look at the gross margin average of the entire time frame before 2020, it would be 13%. So it was still at least moving upward from the 12%, you could argue, in the few years leading up to 2020 before we had the explosion in the gross margins. So the net margin also had a pretty significant jump up with the gross margins. Obviously, the average net margin that we had in the time frame for the first 5 years was really only 1.78%. So just under 2%, very, very low margins. The average over the last 5 years has been 8.4%. So a much stronger average margin, but again, it comes on the back of 2020 and 2021. The average for the entire time frame prior to 2020 is an average of 1.66. So basically in line with the average margin we had for the first 5 years, in fact, slightly lower because of a lost year in 2019. So if you take a look at the entire rolling period, the average margin is about 5%. And that seems to be kind of representative, to be honest. Like, yeah, that includes the 25% that we have right here, but it doesn't seem to be necessarily leaded up by the outlying factor, because we obviously, like I said, have negative years to kind of weigh back that large outlier itself. But either way, as I had said, I did a little bit of analysis of the average and median margins that we found from that website, and was comparing them against the margin in each of these individual years. Obviously, there's only 6 years to work with from that website. But either way, I worked with what I got, and I found that basically on average, the margins of Interfor is 2 times higher than the industry. So pretty significant net margins, and I think it's pretty safe to project that 2 times factor moving forward. So if we think that the industry margin is going to come back down to like 5% or so, then I think it's reasonable to assume that Interfor could sustain a margin of 10% over the time frame. Obviously, yes, they had these are the only years where they had that really strong margin, but they also shifted their business very significantly during that time frame, as we've shown in the graph showing their increase in production off the back of the acquisitions that they did. So moving down into the cash flow line, we can take a look at their free cash flow to equity and the returns that they've had for shareholders. For the first 5 years, they had an average of $16 million that they could pay out to shareholders each year. And the total amount that they did pay out to their shareholders on average is actually negative. They were issuing shares during this time frame. So they were not overpaying the shareholders, definitely not, since they were still issuing equity effectively during that time frame. The average over the next 5 years, or the most recent 5 years, has been 133 million per year, which again comes off of the back of these really, really large years in 2020, 2021. But either way, the cash flow has been really well managed, and the average payment they've made to shareholders has been 70 million per year. So yeah, a very, very significant payouts to the shareholders. Huge buybacks in 2021, $150 million in buybacks and $131 million in that special dividend. So a total payout of $281 million to shareholders in 2021, when they ended the year in 2020 as a $1.6 billion company. So yeah, very, very significant payout in terms of that 17% total common yield. But as I was just saying, it's not overpaying the shareholders in any sort of sense. In fact, you could still argue that over that 5-year period, they still significantly underpaid their shareholders. And if you underpay your shareholders, unless you're throwing the money away into like bad projects, which doesn't seem to be the case with Interfor, then that cash has to go somewhere and ends up on the balance sheet, which we'll get to in a minute. We will take a look at the returns on invested capital. The returns on invested capital over the first 5 years averaged 4.5% or so, with the returns on equity that comes out of that averaging under 4%. So the returns on equity were actually lower than the returns on invested capital, which shows that the balance sheet was not in a good condition, and they were kind of recovering probably from malinvestments in the past. And then over the next 5 years, they had an average return on invested capital of 19.84%. Versus returns on equity of 26.4%. So now they've reversed the position in that balance sheet, showing that the balance sheet has improved significantly over time, which also gives credence to the idea that they can sustain higher margins that they had than they had in the past, based off the fact that they've improved their cost structure by growing their business into it, as we were just discussing. So over the 9-year period, kind of rolling, the returns on invested capital end up at 12%, with the returns on equity ending up at 15%, which is nothing outstanding over that long of a time frame, but pretty respectable. And again, if we shift it down to 5%, it becomes much more in line with the type of investment we would want to make. So really, the best time to invest in them probably would have been like 2017, 2018, when they were at the end of all of the bad times and starting to move into the good times, even though yes, they had a big loss here in 2019, but that was just the start of the boom for them, effectively speaking. So taking a look at the balance sheet, you can see exactly what I was talking about. Obviously ending the year in 2021 with $538 million on the balance sheet. They don't have exactly that amount on their balance sheet because of the first quarter. They made acquisitions, but I believe it's still around $400 million or so as of the last quarter. Although I believe they have other acquisitions also planned in the second quarter, so maybe they're going to end second quarter with no cash. I'm not sure exactly, but if that's the case, then we'll still probably end up with a bigger capital base regardless. But anyway, we take a look at the average cash that they had over the 5-year period. In the first year, it would be $15 million. Over the entire time frame, it averages out to $140 million. So even under that kind of conclusion, if they're at 400 right now, $140 million, they would still have several $100 million that they could effectively be clearing down to bring their balance sheet back to a sort of a longer term average. Of course, like I said, they're growing, so that's not necessarily a logical way to think about this per se. But either way, the cash even just a percentage of the total asset base is still increased rather dramatically too. If you just look at the total assets, for the first 5 years on average, about 1 billion or so on average. So that 15 million versus 1 billion. And then the total assets they have now is 1.7 billion on average for the 5 years. And then the cash that they have is 265 million. So yeah. And then again, even more so if you're just looking at the most recent year, 538 million versus the 2.6 billion. So as a percentage of their total assets, cash is just growing and growing and growing, which really just gives more credence to the idea that they could eventually return that cash. Now taking a look at their liabilities, obviously that's growing too. If we take the average liabilities that they had was 435 million for the first 5 years. Again, that was against the 1 billion or so. So for the next 5 years, 667 million versus, what was it, 1.7 billion. Yeah, and then ending right now, 967 million versus 2.6 billion. Yeah, very, very strong growth in the liabilities, but the assets seem to be growing roughly in line in a proportional sense. It's a couple times extra over it. Nothing too extreme in the growth of liabilities. It also doesn't necessarily look like the assets are growing at a huge clip faster than the liabilities either. And that makes the shareholders' equity grow at a pretty consistent clip as well, but obviously not necessarily a most ridiculous explosion like if they had been paying down their liabilities at a faster clip, like I was saying. But either way, growing from an average over the first 5 years of 608 million to an average of 1 billion or so, ending 1.6 billion, and the retained earnings growing as much. So cash growing, retained earnings growing, shareholders' equity growing, no reason that they can't do special dividends and more share buybacks, especially if the stocks continue to get crunched. If you take a look at the overall net working capital that they have, even if you just take out that becomes 965 minus the was it 321, that's 640 million or so. So you could take out the cash and they would still have positive net working capital as well. Like obviously you wouldn't necessarily want to do all of the cash, but you can maybe just do half the cash. But you could take all of the cash out and they would still have positive net working capital, which is pretty neat. So very, very strong balance sheet, basically arguing that they can make massive returns moving forward. So now thinking about the future, well, actually, I guess we'll take a look at their multiple as well. You can see their multiple was all over the place for the first 5 years. We have a pretty chaotic negative number right there that we can kind of ignore. I'll ignore all the negative numbers, which really just leaves us with a few numbers. I can see that they were kind of averaging a pretty high multiple, maybe in the teens, but possibly into the 20s and into the 30s for certain years, showing that there was expectations of growth. But you can see the multiple moving down over the time frame. Big loss here in 2019 again, and then 2020 it's been trading at 5.6. People knew that there was a good boom time, but they were expecting that it was going to come down again. That same pricing exists here in 2021, and it's even getting further and further, which is probably one of the reasons it's going to necessarily attract some people to looking at the stock, is because, wow, if you see a PE of 1 to 2, you're just like, this is insane. And this is the thing, it's pretty arguable that they'll be able to earn that type of earnings for at least another quarter or two before this starts to come down. And then the real question is, how far is it going to come down? Which is, the thing that we're gonna definitely get into. Take a look at the sales to capital ratio. Sales to capital ratio also over the first 5 years averaged 1.64. In the next 5 years, it's pushed up to 1.99. So there is a consistent growth in the sales capital ratio. They've been growing their sales very strongly, but they've been keeping their capital base under control as they do that. Like I said, they've been growing their capital base, but the sales is growing faster than the capital base, which is really, really great. We always like to see that. So anyway, now we'll actually start to take a look at the future projections, and we'll show you kind of how we get there. Before we are going to look specifically at projections for the company, we are going to have to take a look at the underlying asset, because this is a commodity-based company. So I'm doing a bit of a commodity price correlation, which I have in the separate page for the valuation, which we'll get into. So I have my spreadsheet for lumber up right here, where I have the prices for lumber going back way back to 2011. Although I have a special page that's just not connected to this graph that has the yearly price moving back even or further than that. But at least on this information right here, I have daily information, which gives me the ability to do some correlation work. You can see that lumber was pretty consistent in this kind of like 200 to 300, 400 kind of range for quite some time, all the way up through 2017, 2018. When it then spiked up to, what is it, around 650 or so, where it topped out around in 2018, then crashed back down. And then, but when after 2020 happened, it had a little initial crash and then has spiked ever since then, all the way up here to 2016, 1700 or so, then spiking back down, spiking back up, and spiking back down. And here we are playing this game of wondering where lumber is going to go in the long term. So I have my own kind of like ways of trying to think about where commodities can go in the future based off of my views having to do with monetary economics. But I also like to just take account of the future history and think about kind of like a statistical probability of returning to price based off of just the historic past. I kind of mix both of those two ideas together to kind of come up with what I think. Sometimes I look at the average price projection for analysts. And then oftentimes I just think about like, what is it average over for the last year? So taking a look at kind of like all of those thoughts together, I do have another spreadsheet that includes the total money supply for the United States. And I have that kind of correlated against the growth in lumber, which gives me projections based off of the idea that either the money supply grows at 0% for the next 5 years, or it grows at twice as fast as it's grown for the last 5 years, which would mean 18 to 19% per year, and anywhere in between. And then kind of come up with how much currency I think would have at the end of the 5 year based off that. And then what does the correlation suggest that the price of lumber would be based off that? So that gets me prices of anywhere from $807 to $2,100 for lumber 5 years from now. Based off this chart, you can see that's a pretty wide range in here of potential prices that says it could go, but that's off the idea that it would grow, obviously, because that's like it's grown over time. The correlation is going to assume it's going to keep growing. So maybe you don't think it's going to keep growing. Maybe you think it's going to go down. Like I said, that's just one way of thinking about it. But based off the idea that it's going to grow in line with the money supply, I see prices of anywhere from 800 to 2100, 1400 kind of being the average for that. Now, if we also take a look at the historic prices, like I said, for the last 30 years, the year-end price has been anywhere from $148 to $1,100. For 30 years. 30 years is a statistically significant number, so that's why I chose that. Splitting it into quartiles after putting them into even numbers, and then taking the average quartile for those prices, I get different quartile prices for lumber prices, which do tend to kind of stay around this 200 to 300 price. You may notice, as we shown on the chart, it really did kind of stay in that same range for quite a long period of time. So there's a lot of kind of laggard to the low side and in the historic estimates, and then there's a little bit of a larger lean towards the upside in the kind of future projection based numbers. And so when I make my assumptions about where I think lumber's going to go, I use a little bit of both. I have my kind of standard model system where I have 5 models plus kind of an extra 6th one that I kind of make out to be an analyst model, or sometimes it's a little bit of a mixture of different other factors. So I'm going to put my 5 models in based off of a few other things. The analyst model is going to be based off of the average of the last year. The average price for lumber has been $826, so that one's going to be number 6. Effectively speaking. But for the first 5, I'm including the quartile prices, first and third quartile. Is that what I did? Yeah, first and third quartile. The middle one is actually the average between all of the quartile prices and the projection prices. So it's basically kind of in the middle. And then the 807 is on the lower end of the future projections, with the 1400 being the average between the highest one and the lowest one. Actually, that's where that one come from. So I'm not even including the 2100, which is the highest end of the projection one. I'm not even including that one. If I wanted to be super bullish on lumber, I could include that one, but I'm not going to. I'm going to kind of lean towards what I think is being more conservative. And then, like I said, using 30 years backward or I guess 25 to 30 years is what that represents. 25 to 30 years backward for a lumber price as a projection, I think, is also a pretty conservative estimate as well. So based off of those lumber prices, correlating it against the stock, I get, or against the revenues that I get projected revenues of anywhere from 1.3 billion to 3.8 billion in the 5-year forward period. I also like to do, and so those are the prices, those are the revenues that we're going to use. Like I said, 1.3 billion to 3.8, and then the average, which is like 800 price for lumber, gets me 2.2. That gets me expected revenues of 2.2 billion or so. I'm using a perfectly even distribution, 16 to 17% each for each one. We're not distributing it into some sort of way that leans towards which model I want. When I use commodity pricing, I just use the same distribution across the one. It's a flat distribution. But anyway, another thing I like to do is also just take the price of the stock and compare it to the price of lumber. We don't have to necessarily take the lumber revenues and try to do the normal DCF. Sometimes I just like to see, hey, what is the price of the stock correlate with lumber? So if we just take the price of lumber and the price of stock that we have, which goes back to 2006, you can find out that the stock and lumber actually correlate with each other 88%, which is pretty neat. So based off of that, if you just plug in the current lumber price, it would suggest to you that it might trade at $18.73. It's currently trading at $21.29. So with that argument, there's a little bit of downside currently based off of the current lumber price. Or you could argue that that the traders believe that lumber is a little bit underpriced with that argument too. It could go either way. Either IFSPF is slightly overpriced to the correlation of lumber currently, or maybe lumber is underpriced, one or the other. Either way, like I said, that's more of just a pure technical based metric. I like to use mostly just the correlation of the revenues, and then we're going to build our DCF base off of that. So with our expected revenues of 2.2 billion, again, that's compared to 3.2 billion in the most recent year, but they had 2.2 billion in 2020. So we're effectively assuming that they're going to return in 5 years' time to around 2020 revenues, which I don't think that's insane. I think that's a pretty reasonable estimation. That basically means they're going to lose 32% of their revenues over a 5-year period, a negative 7.5% CAGR for the next 5 years in revenues, which is not great, right? But hey, that is what it is. Again, now we get to the fun part, which is the margins, where, like I said, they have huge, strong margins in the most recent year that are just not sustainable. 25%. That compares again to the industrial average of either 16% if you go by DeMotoron's number, or possibly 8% as a median according to this website, or what was it, 8? Oh, never mind, it was still 8%. According to that website as an average. So 8% according to that website, 16% according to DeMotoron, 25% is what IFSPF got. And like I said, over the long term, according to that website, it seems like IFSPF gets 2 times the margins that they do. So I don't know. if we think that the industry is going to maybe return to a 5% margin, which is kind of what the average that they seem to get according to that website, then maybe IFSPF could return to around a 10% margin. That's basically the logic I get to is if they get about a 5% margin over the long run, then why doesn't IFSPF get a 10% margin if they supposedly get twice as much? So I have the margins going from 1% to 15% and leaning towards 10%. That middle number is 8 with the lean towards 10. That makes our expected margin 9.89. That's slightly lower than 10, but it's basically about 10. So that's basically how I get to these margins, which is where I think, that's where a lot of the argument around this stock is going to be, because the margins affects everything. I mean, the revenues affect everything too. Obviously, if you believe lumber is going to go to 2100, like I saw as a really outsized potentiality, then that would really throw the profits up another screw too, depending on how much capital they have to invest to achieve the ability to work on that lumber price. But either way, here I have the revenues going from 1 to 15%. But if you thought the margins were only going to be slightly above average, and average is going to be 5%, so maybe they get 6%, well, then maybe that drops your expectations down pretty significantly, maybe something like that. And then, wow, now the price becomes worth $32. I mean, even that's with 6 to 7%. Again, you could make this go lower. So I don't know. It depends on where you think the margin's going to go. That definitely has a huge effect on these assumptions. I lean towards thinking that they can probably get 9 to 10% over the long term, and that makes me get to this valuation right here. Now, taking a look at the other assumptions, because they do matter as well, the capital and the debt assumptions, but they're a little bit more minor, I think, in this case. I have the debt assumption going from 5% to 100%, leaning towards 50. That gets me an expectation of 52%, which is actually a pretty significant increase in the debt, but that is one way in which I'm actually sandbagging their numbers a bit. And I would argue that that's a pretty reasonable assumption to make. You notice that every time I increase the debt, no matter which way I increased it, it basically increased. Every time I lowered the debt, it increased the value, no matter what I did. So by leaving the debt ratio high, it bakes in the assumption that the market cap is going to drop in the near term, which I do think that there's more downside in the near term, which is why I say it's like there's some caveats to this really good valuation I'm presenting right here. I think there's a really great value here, but it's probably going to be painful over the next year or two, just because there's so much uncertainty, and it's just going to be rough. But it may already be well priced in. Like I said, it's trading at a PE of less than 2, so that's pretty intense. That's a pretty low PE ratio. That's a lot of uncertainty baked in, which is why they can pay out such huge dividends. Is because, like, wow, when you're trading that fucking cheap, man, don't mean to cursing necessarily, but I curse sometimes on channel, but I'm trying to not do that. Anyway, so we're gonna leave that assumption in there. Like I said, I think that's us being a little bit more conservative. The sales to capital ratio, I have it going from 0.5 to 3, leaning towards 2. That gets us an expected ratio of around 2. They most recently had 2.18, and then over the last 5 years, it's been an average of 2. Over the last 9 years, it's more like 1.8. You could argue that I could maybe be a little bit more conservative in that one, but I think it's a pretty fair assumption, especially since they've been buying back stock, increasing their revenue base. I see no reason that they can't sustain that too, effectively speaking. So I'm willing to leave that one in there. And so then with that brings the default assumptions that are in here, which is pretty significant default chance in the two worst case scenarios. It does bring it up to about 2%. I have said before that if it gets significantly over 1%, because it's a per year compounded default risk, that means it starts to stack up pretty significantly. So 2% means that there's perhaps a 10% chance here of default. But again, that's also assuming a potentiality of that 1% in there as one of the reasons why that ends up that way. It also assumes they take on a massive amount of debt, bringing their sales to capital ratio below 1, which is honestly probably very unlikely to get it below 1, given their financial history. So that's a little bit more of me being conservative again. So you could argue that maybe it actually would be more like 1.7 or something if I was being a little bit less conservative in those metrics. But honestly, just because of how great the valuation was coming out, I was sitting here like, what am I missing? It's one of these things where it's like if you see a really great value, on one hand you want to jump on it, but on the other hand you got to be skeptical. You got to be like, all right, what am I screwing up here? What's the catch? You know, what is it that I am missing that the rest of the market sees? That's the question you have to be asking. Now, and that very well might be that the thing that the market sees is lumber going back to 200. That's probably the thing the market sees. Is the market is like, oh my gosh, lumber is going to go to 200. Oh my gosh, and it's going to be 205 years from now. Now, I doubt it'll be 205 years from now, but we have built a valuation based off of that. We have seen what it would look like if they had lumbers go to 200. Lumber goes to 200. I think their sales goes to 1.3 billion. If their sales goes to 1.3 billion, I think they very well might have to double up on their debt, and they very well might have to have their market cap crash 50% at the same time, which means their debt to equity ratio would jump from 26% to 100%, and then that would give them a significant amount of default risk, and then their profit margins might only be 1% in the 5-year forward period. Now, that's the part that I think is less likely, that in 5 years forward time, they still only have a 1% profit margin. That's the part that I would find unlikely. But we still have that built in as a potentiality here. In fact, we gave it a 17% chance of happening. And under that 17% chance of happening, the stock ends up worth $8.50 today. And it's worth $13 to $14 5 years from now. Pretty bad circumstance, but it's also the only money losing circumstance in this entire valuation. So that's basically kind of what we end up with. So yeah, I kind of almost gave a partial conclusion to the whole valuation right there. This is basically all the assumptions. I will do. I will more formally kind of finish it up right now. Like I said, I don't really have any other things I want to adjust here. I spent the most time trying to figure out what I wanted to do with the margins, because I knew that was going to be a real question, considering they had these really, really bad margins in the past. It makes it very hard to then argue that they can then just sustain a 10% margin moving forward. But I think I've hopefully done a good job of justifying that, showing that even in some of the lower margin years, which because we included these years when we were looking at those margins, we still found that they were typically about twice as good as the industry on any given year. So yeah. And then, like I said, I think we've hopefully done a good job of explaining how even if lumber prices were to collapse back down to some pretty low levels, I think 200 is probably saying a lot. Obviously, even if it came back down to this kind of like lull it had over here, that would still be maybe in the 400 range, right? And that still significantly changes the valuation as well. So either way, no matter how you want to think about it, whether it's about the lumber price or about the margins, which set of uncertainty you can't necessarily figure out your answer for, I've hopefully come up with my answers for it, and it really gets me a pretty good valuation here. So with that, we will bring this one kind of to a more formal conclusion. IFSPF Interfor, main lumber producer, as we discussed. The U.S. Treasury is back down to 2.96%. I see it was back up to like 3.3%, and then it's back down to 2.9 again here. Looks like the markets are having difficulty deciding whether or not they want to let the Treasury price in 3%, which is not very good for economic views in the future. But I digress. Let's stay focused on the valuation at hand. Equity risk premium that I currently have is 5.79%. Discount rate that I come up to after adjusting for company-specific risk, I get to 9.77%. They do not currently have a dividend. As I said, it's not a regular dividend, but I do think that there's a very significant chance that they pay out another special dividend within the next year or two. And so if you buy the stock, you very well might get to benefit from that. And there's also likely to be a pop when they announce that will happen. So you want to be in the stock before they announce that there's going to be a special dividend. If you want to be in it for the special dividend, typically speaking. So that's just is what it is. I mention all that because obviously with the great valuation in front of us here, it very much leads the question of whether or not I want to add it to my portfolio. But I guess we'll get to that when I finish doing this summary. But anyway, sales 5 years ago, $1.7 billion. In the most recent years, $3.2 billion. Hold on just a second. Hold on. A little bit of a technical issue over here. Sorry. That comes to sales growth of just under 13% per year for the last 5 years. The sales capital ratio for the last 5 years on average has been about 2. against the industrial average of 2.71. So they actually do have relatively low sales capital ratio compared to their industry, but that really only backs up the logic that they can sustain the higher margins, because as I've talked about on the channel before, typically there's a little bit of a balancing act between the two for most companies. And they kind of already have pretty good in both categories as far as I'm concerned. But if that makes sense that they would do worse than their industry in one of these categories if they're doing so much better than their industry in the other category. Anyway. Returns on invested capital over the last 9 years on average has been about 12%. The debt to equity ratio is currently about 26%. In the most recent year, they had basically no default risk, less than 1% or so. Profit margins for the last 9 years on a rolling basis has been 5% against the industrial expectations of the most recent year, again, of 16.5%. Again, that came from the Demoteron data set, and according to the other data set that we had, it was more like 8%. So take it however you want to look at that. Either way, it kind of still leads into exactly what I was saying. Profit margins in the most recent year has been $819 million. So really, really strong profits. Again, I think it's pretty sustainable to believe that they would be able to do basically in line with that for at least another quarter or two, which would just think about how much cash that adds to the balance sheet, essentially. And anyway, present value is the present stock price is currently $21.29. The probability distribution, we're using a perfectly flat distribution, which is what we typically do for a commodity based stock. We try not to have any specific views about what we think the price of the commodity is going to be, and try to have as neutral of a perspective on that when we do it, because commodities can go wherever they want to go. Frankly, it can be a little difficult to predict where commodities can go, so we try to leave that in one area while doing the valuation in another area. Either way, we have sales driving lumber prices projected anywhere from $219 in the 5-year forward period to possibly $1,400 in the 5-year period. The expected price that we come up with after adjusting for the distribution, we end up with $670 as our 5-year forward lumber projected price, which I think is pretty reasonable. It's actually relatively close to where it's currently at. I think it's like only a couple dollars higher than that right now. So we're effectively saying that we think lumber is going to be flat over 5 years. I think it's very, very possible that it goes down 50%, maybe 75% in the near term, but then bounces back up to that. But again, I'm trying to figure out where I think they'll be 5 years from now. But anyway, that gets us sales of anywhere from 1.3 billion in the worst case scenario to possibly 3.8 billion in the best case scenario. On an expected basis, we see 2.2 billion. Sales capital ratio on expected basis, we see just over 2. And return on invested capital, after adjusting for all of our assumptions, it brings us up to 20% over the period, which is much higher than they were over the 5-year forward period, or over the 5-year historic period, but is much lower than the most recent 2 years. So it kind of, I think, evens out with those things in mind. The debt to equity ratio on an expected basis, we see about 52%, which, like I said, that might be one of the areas where I'm being a little bit more conservative, and that brings it to a default risk of just over 2% per year, which, yeah, again, also perhaps a little bit more conservative. But again, we have to adjust for the potential that it really does go down to some worst case scenario lumber prices. And so this is just me trying to be realistic about the potential risks in the company. And like I've talked about some other companies that we have looked at recently that had some very significant default risk, and I was very quick to agree with some people in the chat who were like hard pass on that one. This one for me is just not as quick of a hard pass, because I really do look at this worst case scenario as being supremely unlikely. And then I look at this one as being pretty unlikely, but not that terrible of a scenario at the end of the day. Yeah, it's only 6% per year, so that's not really a great return, but it wouldn't be a loss. But I don't think it's super likely that lumber prices would stay that depressed that long. This middle case, I think, is so much more likely to happen than either of those ones, and yet I'm weighing them equally with each other. So that's just, again, ways in which I'm being conservative in the valuation. But either way, I have profit margin, a distribution of anywhere from 1% to 15%. The expected basis, we end up with 9.89%, and that gets us profit anywhere from $13 million to $574 million in the 5-year forward period. On an expected basis, we see $221 million per year in that terminal year. That gets us a present value price after adjusting for the discount rate that we're using of $44.57, which is more than double the current share price. So yeah, very, very strong upside to the current present value. Lots of people pricing in their concerns about the lumber price, as well as, like I said, the other potentialities and uncertainties about where the lumber price is going to leave the profit margin in the future. We have 5-year forward value targets, unadjusted for any special dividends that they could and probably will pay out during the period, of anywhere from $13.57 to possibly $180.52. On expected basis, I see $71.03. Against the current share price, that brings an expected return for the next 5 years of 27%, 0.25%. So yeah, very, very strong expected returns. The value score I end up with is 1.67, which puts it pretty high on the list. Was it like number 2, number 3, or something like that? The short-term pricing, which as I've talked about in other streams, is not necessarily super representative. It's more of like an icing on the cake thing, but it also seems to agree that there's a pretty good upside based off of the multiples, but that's based off of assumptions about multiples that don't necessarily apply to these types of companies, so that doesn't necessarily make too much sense. The only one of these that does make sense to me, which like I said, is more of the driver pricing, basically just taking a correlation of lumber against the stock. And we already talked about that. It actually suggests that maybe it should be about $18 to $19 rather than $21. So based off that, if just looking at the lumber price and just looking at the stock price, you would argue that maybe Interfor is slightly overvalued or that lumber is slightly underpriced. But if you're looking at the cash flows based off of the lumber price, in my estimation, it's worth more like $44, $45. So yeah, coming back over to the watch list, as I was saying, it does rank very, very highly on the list. It's number 2. Is that it? Yeah, number 2 on the list. I'm very, very interested in starting a position in it for that reason. I've actually owned it in the past. I owned it for a relatively short period of time because it kind of zoomed up in price at the same time that I was readjusting some things on it. I do actually have my previous valuation up here on the other screen to kind of compare with that. And I was kind of also comparing it with because I had made adjustments to the valuation after doing my first stream on the stock, but I also was rewatching that first stream to kind of see that. So kind of looking at 3 different valuations, my current one and 2 past ones effectively, where I went from being kind of moderately optimistic on the stock to being very pessimistic on the stock to this one where I'm a little bit more optimistic on the stock. And it all basically boils down to that margin and wondering where it's going to go. I've gone from anywhere believing that no, actually their margins are just going to crash back down to like 2 to 3% at best, to believing that here, like I said, now I think that they can maybe sustain like a 9 to 10%. And so depending on where you end up on is really going to decide where you think about the stock. The funny thing is that my beliefs about the lumber price and my beliefs about where that leaves revenues hasn't shifted all that much from these valuations. I've looked at it and it's like, well, the projected lumber price shifts around a little bit. It's like $100 higher, $100 lower here, but the revenues only end up like 100 million higher or 200 million lower. Nothing too crazy. It's it's in the same ballpark, but it's really the margin. Margin's what matters. So I don't know. I guess I'm feeling optimistic on the stock right now. Who knows? Maybe in a year from now, I'll suddenly believe that they can only achieve 4% margins or something, and that would dramatically change everything. But I don't think that necessarily does change everything. As I was saying earlier, if we try to maybe take a look at that right now, you can make it. Okay, well, that dropped it down to more like 5 to 6%, but that makes it more like this. So let's see. Let's go lower. Let's try to really see what it looks like. 4% margins makes it fair value. If you think that they can only get 4% margins, well, it's only got a little bit of upside. Now, I feel pretty good about this 9 to 10%, like I said. That gets me to that level. But that's definitely the key to most valuations is being able to, I guess, feel comfortable with where you're leaving it. So with that, we will basically bring the stream to a close. I will likely start a position in the stock in the near future, like I was saying. However, I will probably go very, very slow on the buying of this one because, like I said, I do think in the short term there's a lot of potential for downside based off of the concerns and risks surrounding lumber prices and commodities and interest rates and the recession and home prices and everything. It's all tied together. There's a lot of concerns we had. And with that, I will also bring attention to the fact that we get the CPI report tomorrow. That's going to be very, very exciting in the morning. It's for good or ill. We'll see what comes out of that. The day after, we'll get the PPI numbers, which kind of is a leading indicator of future CPI potentials, as well as we'll get retail sales, import-export prices, industrial production, and business inventories, consumer sentiment all throughout the rest of the week. And then over the next week or two, we get more information as well, as including a new FOMC meeting. And eventually we're getting the GDP numbers later on in the month. So that's going to do it for us today. Like I said at the start of the stream, I'm probably going to be doing Graph Tech next, hopefully on Thursday. I do need to finish up the valuation on that one today if I want to hopefully do that. So we'll see whether or not that actually happens or not. Maybe it'll have to be pushed back to next week. But either way, hoping to do Graph Tech next. If you made it this far and you haven't already liked the stream, it'd be very much appreciated if you would give us a like. And if you're not already subscribed to the channel, please subscribe. That way you'll get notifications letting you know when we go live or whenever I release other videos, like my Q2 market update video, which if you haven't already watched, please go check that out. And if you're not part of the Discord, you should also join the Discord. The link is in the description below. We like having discussions and spreading ideas amongst like-minded individuals, as well as also getting more stream notifications from me there. All right, I'll catch you all again next time.